why are we having this session on corporate governance? And Asad wanted me to twist this presentation a little more with international evidence. So everywhere you look, there are now hundreds of studies empirically proving that corporate governance matters. I'm just going to bring out some few messages on why corporate governance matters, but there's much more exciting literature on this, and it's complicated because it's more analytical. There's strong connection between board composition and market valuation of emerging market companies that has been empirically tested now. Companies with higher proportion of outsider independent board of directors tend to report higher valuation. For example, and I'll, for time's sake, just talk about Korean firms. Because Korea, as you know, went through a 1997 financial crisis, and I was a part of the team that actually was working on Korea in the financial sector resolution. But the cause of the financial sector resolution was over-leveraging by the chaebols, the large conglomerates that had interconnected lending and reckless lending. And we found that Korea actually is a nation which has a lot of dignity. Whenever I met Koreans, they were very sorry how messed up their state was. And they actually grapple with their problems quite amazingly. And I remember that we gave them a $4 billion loan as a part of the total rescue package of $35 billion along with the IMF and the World Bank. Then $4 billion was the contribution of Asian Development Bank, which we were leading on my side. And we found that they were insistent, while I was still on the seat, they insisted on repaying the loan as soon as they were able to resolve the liquidity problem. The pride of the nation is very important in rescue and resolution. Korean firms with 50% outside directors have reportedly 40% higher share prices. So that also confirms that it makes a difference to have. Stronger board structures reduce the likelihood of fraud, expropriation through related party transactions, which is another positive angle to it. And so, you can actually today, with the data that's available internationally, maybe not here in Pakistan, you can actually empirically test these things. And I know Nadeem from State Bank, when he gets hold of the data, he should be able to do that for Pakistan, because he wrote one of the first empirically interesting articles in early 2000 on corporate governance. In Pakistan, there's been less empirical research on this. Corporate governance practices changes are significant across almost every country that I have seen, except perhaps MENA, some parts of South Asia, and African countries too. It has clearly made a qualitative difference, and it is visible in one, firms' performance improvements, although it varies, but by and large firms' performance improves, again empirically tested. There's also a trend that's emerging, which is called the convergence in corporate governance across companies and countries. This is moving somewhat slower. I raise this point because of the cross-border listings that are very popular these days to raise capital market money across the borders. GDP growth, productivity growth, ratio of investment to GDP, again very positive trends for corporate governance. The growth effect is particularly pronounced for industries that are most dependent on external finance, because the external discipline from the, particularly if you're listing at London Stock Exchange and others, is more steeper requirements than what you have. Recurring crisis has brought home, and I'm talking about the global crisis and regional crisis, has brought home further with every round of crisis significance of corporate governance. I talked to you about Korea, Indonesia, Thailand, Philippines, all these countries that I was involved in the rescue package in 1997-98, everybody adopted new codes of corporate governance and really set up proper institutes with the support of international agencies, and they made a sincere effort to resolve. I'm not saying every country has resolved this problem, but as you will see, there have been some positive steps that have been taken. Can fixing code of corporate governance of SOEs do the trick, was the question I was trying to examine. I think this is a tremendously long debate, but international evidence has confirmed that corporate governance policy strengthening is necessary but not sufficient to ensure effectivity and results. And I will revisit this point again. This is because, first, SOE corporate governance reforms cannot be effective without strong political commitment, nor implemented or sustained without an accommodative and supportive overall public sector governance environment and framework. You know, you can't say, I'm going to fix my firm's corporate governance and the rest of Pakistan is going in an opposite direction of not respecting the rules of the game. So you can't really fix a state-owned enterprise corporate governance without getting the whole religion of governance right within the country. Second point, SOE reforms cannot take off unless there is a deeper recognition and consensus that these firms are strategic state assets. And it is incumbent on key stakeholders, that is the government and more so the legislature, to recognize that they serve only, quote unquote, only as a custodian of these assets and are accountable to the nation for negligence in policy and implementation. This recognition came to me when I was sitting in an official forum and one minister, when we were trying to privatize a company, said, "What are you talking about? This is my company." Now, it is not a company of an individual. It is not a company of even the government as per se. These are public assets. So we are accountable on these public assets, and how we use them, we should have more accountability on. This culture and this awareness, we all should play a role in enhancing it. The third point about the code of corporate governance, you know, I'm just giving some measured and reflections out here, that we shouldn't think that just fixing a code will fix the problem, is the whole discipline of self-regulation of corporate governance. Now, there was a huge tendency in 80s, which grew, amplified in 90s and then in 2000, that we have to let the industry self-regulate itself, be it the corporate or the financial industry. Look at the results today, globally, of self-regulation, how messed up the world is today, how much losses we are incurring because of exclusive faith in self-regulation. So we cannot think that by announcing the code we will have the problem solved. These failures of self-regulation will be documented further as evidence comes out. And it's been, whether it was Asian crisis, Russian crisis, the long-term capital crisis in US, the housing bubble followed by subprime mortgage, and now the havoc played by the European crisis, is proving time and again that while self-regulation serves the industry interest well, but cannot control greed and cannot serve public interest well. It is the Senate, it's the Congress in US that is calling for revision of legislation, as we know, even on the commodity trading and stuff, that these are being revised. But you know, you need a legislature that is awake, that understands the gravity of the problem,